What's going on, investing fam? You're listening to the Stock Market Tour Guide podcast, where I help you navigate the uncertain world that is the stock market. I'm your host, Stock Market Jay, and I'm here to save the day, bringing you news you can use with helpful insights, fundamental analysis, strategies, and helpful tools. All right, guys, so today we're going to be discussing bear market investing. Okay, so before we get started, I just have to let you know I'm not your financial advisor. This is not financial advice. Just a fundamental stock market investor looking to educate people. This is an educational platform. All I want to do is provide information, value, my experiences through my time investing, things like that. Okay, I'm not here to be a guru or anything like that, but I am here to help as many people as I can because I know how crazy and uncertain the world of the stock market can be due to me being, a new investor at one point, someone who hadn't done any investing in the stocks, didn't know how it worked, bumped my head along the way. But my goal and my mission is to help as many people safely and intelligently invest. And you can only do that with proper education. You have to take that pride in being able to educate yourself, by any means, whether it's seeking advice from others, watching different content, listening to different content. I watch Yahoo Finance every morning. Watch things on CNBC every day. Watch daily content that I absorb. I've taken courses, things like that. You have to get yourself. You have to make yourself. You have to equip yourself with the tools that you need in order to succeed in the game of investing. You can't win until you know how to play the game. So you have to dive deep. You have to do deep diving, right? What I like to call deep diving. Immerse yourself into whatever it is you're looking to do, right? You have to become obsessed with it. You'd rather be an inch wide and a mile deep instead of a mile wide and an inch deep, right? You want to do what we call deep diving. So you have to learn all the ins and outs of it. But anyway, that's a little bit about me and what I like to do for all my new listeners. Everyone, welcome. Like I said, educational platform. This is all for teaching purposes only, right? So investing in a bear market is going to be tricky because for a lot of people, they look at it as a destruction of wealth. When in all actuality, it's a chance for a transfer of wealth. Stocks get beat up. Okay, that's been a historical thing for a long time. Stocks have been around for a long time. Stocks go into bear markets. Stocks have market crashes. Stocks have market corrections. You have to understand the history of the asset class you're investing in, or anything that you do in life for that matter. You have to understand the history of it so you can understand the present and build towards the future, right? Because that's all investing is anyway. It's putting your money somewhere in a vehicle to work for you, in a tool to work for you, an asset class to work for you, and getting it to grow for you over time. It's for the future, right? It's to cash flow now and appreciate and value in the future. That's what you want it to do. That's the name of the game. So when it comes to investing, you have to educate yourself in order to be able to best position yourself in order to get the most out of your money in that situation of investing. So you have to understand the history of it when it comes to stocks and bear markets or market crashes, things of that nature. There have been about 8 market crashes since 1929. That's 1929, all right? So like I said, the markets happen in cycles and things just repeat themselves. That's why I say you have to understand the past in order to understand the future and where you're going. So there have been like 8 market crashes in history. Most recently, it's going to be COVID. And the crash is just it's a drastic decrease it's a drastic decrease, like a percentage-wise, in an asset class. Okay, so what we're going to say is like for COVID during 2020, I believe the stock market went down. Like these are percentage points, so these numbers got really big, right? They rebounded fairly quickly, but these numbers got really big. They went down 60, 70, 80% a day, just wiped out. This is in one day. A lot of value. Like it's just like it's crashing, it's coming down right now. A bear market. We're in a bear market right now. So what bear markets are, and it's been 26 of those in history, okay, since 1929. All right, so that just lets you know how frequent they are and how a part of the culture that is investing, right? The culture that is stock market investing. It's a part of it. It's a part. It happens. It's happening with crypto. The different crypto renters. It happens like once every 2 years. What has been since it came about. And as all new disruptive technologies do, they go through growing pains. But in the stock market in particular, there have been 26 bear markets since 1929. It's been a long time. It's been around for a long time, and the cycles go up and down. They last for different durations. It's up to you to have the emotional fortitude and the fundamental prowess to be able to effectively navigate and then build that wealth, right? Back to market crashes. So we had the one COVID. That was a big time market crash. It happened in the instant blink of a dime. This is when people thought the economy was going to be shut down for at least 3 years. And the way the stock market is, it reacts off of emotion, right? It reacts off of business. If you're the stock market and you hear the economy is going to be shut down for 3 years, the stock market thinks, this is bad for business. Businesses can't make money. If the economy shut down, businesses can't make money. Businesses can't produce a product or services. Businesses can't, keep the economy going, right, and growing. Because that's what the marketplace is: buy, sell, barter, right? That's what companies' growth is measured by. The GDP. That's what the company's growth is measured by. So the stock market thinks, okay, we don't have. If the world is shut down as everyone thought it was going to be, then people can't work. If people can't work, things can't be produced. If things can't be produced, the economy won't run, right? So as a result, the market crashed. You had the 2008 financial crisis, the housing bubble. You had the .com crash in the early 2000s. When Y2K, everyone thought that the world was gonna end, computers were gonna, shut down, all that good jazz, right? We had a Great Depression in 1929. Man, markets have been crashing decades over time, right? Centuries over time, right? But you have to understand what that does to people is when they see that what they deem to be a destruction of wealth. Like I said, I look at it as a time that's the time for wealth creation. During times of contraction, you have to think expansion, right? When things are contracting, when people are struggling to make money, when the cost of living goes up, when everything is getting tighter and getting harder on you as a consumer or as an individual, you have to go deep into whatever it is you're doing, whatever your hustle is, your side hustle, whatever investments you have, whatever product or service you offer. You have to go deep into that. You have to immerse yourself into it and double down, triple down, and add that much more value in order to expand. Because people, in times of need, people need things, right? So during times of contraction, you have to think expansion, right? So during bear markets happen, and the crazy thing is, it's always a bull market somewhere. So that means right now, during different sectors of the market, because there are booms and busts everywhere throughout the different sectors of the stock market, right? So booming right now is going to be commodities. They're through the roof because inflation is up. Everything costs more. The consumer defensive sectors, your household items, your food, your beverages, things like that. That's going up through the roof right now. These are commodities, gas, your energy companies, they're going up right now because these are things that you need, that you have to have to survive. So that's where all the money is going, right? And if that's where all the money is going, then that's where all the money is flowing in the markets. You have to understand this. So it's always a bull market somewhere, but just because certain sectors are crashing, which every sector goes through bear markets, bull markets, market corrections. Every sector goes through it regularly. It's like a cycle. They happen in cycles, right? And if you can understand the cycles and pinpoint the cycles, you can better place yourself in the cycles to be able to get the most out of them. But what people don't realize is a bear market it provides you with an awesome opportunity to buy wonderful companies at a discounted price. Okay, you can't buy Coca-Cola in a bull market for $50. All right, you can buy in a bull market Coca-Cola selling at $64 a share. In a bear market cycle, you can get it on sale $40-some, $50-some, right? You can't get these great companies at wonderful prices during bull market cycles. Okay, that only happens during bear markets and market crashes, and then the market corrections, like I said, it's just a 10% change from the most recent highs. So if it corrects itself, it goes down 10%. But I mean, I would rather have a 25%, 20%, a 30% discount on a company as opposed to just a 10%, right? When you go to the grocery store, you don't just want 10% off, you know. You want to get 20%, 50%, 40%. People love those type of sales. That's why people love Black Friday so much and Cyber Monday and things like that. Well, that's what a bear market is. That's what a market crash is. Because you're getting those companies at an extreme discount. Some companies are down 40%, 50%, 70% from highs. You know, that's the state of the markets we're in. Indexes are down, okay? Indexes are down. The Dow is nearing a bear market, down 17%. S&P 500 crossed over to a bear market about a week and a half ago. It's down about 22%. NASDAQ is in a crash. NASDAQ is in a crash, down 30+%. You want these discounts, right? When Cyber Monday comes, you get all those electronics 50% off, 40% off. You ain't doing no complaining. You rushing for that, right? Well, the beautiful thing with the stock market is the stock price can get detached from great company fundamentals, from wonderful companies, as Warren Buffett so eloquently put it. During these times, these downtimes in the stock market, which you have to be ready for, you have to be cash ready for, because great companies, wonderful companies sell at a discount, at an extreme discount, okay? You guys just don't understand my pain right now. Like, you got great companies that are down. Facebook is down. Netflix is down, Amazon is down, great companies, right? Google is down, Tesla is down, great companies, Apple is down. These are great companies down 20+% right now on sale. Haven't been trading at these valuations since 2019, okay? These are great times to buy. And people aren't rushing out to get it like it's a Black Friday sale. This is where you build wealth at though, right? This is where you add new positions at discounted prices. This is where you add average down in current positions and add new stocks at lower prices. This is where you increase your dividend income, because these companies are selling these great companies are selling so cheap, you're averaging down while you're doing it. You know what I'm saying? This is how you build wealth right here. And people will go blow wealth at the whatever electronics store or whatever type of sale they have going on for Black Friday, instead of deploying capital into the markets, new capital into the markets, and growing that net worth. You know, it's gonna be when the markets are crashing, it's pretty much down. If you deploy enough new capital into the markets, you can get your profile to kind of even out, which is what I've seen over time. And when the market finally has those good days, those expansion days, you just see your portfolio balloon. Don't get me wrong, the markets will take back those gains day after day, week after week. In a bear market, it's pretty much uncertain, right? It's uncertain whether a great company you invest in, even if they come out with great news, even if they beat earnings, even if they grow revenue, net income, free cash flow, they can grow everything, right? And they'll still go down in a bear market, because maybe another company in that sector, in that industry, reported bad news that'll affect the company that you have. The stock price can get detached from great company fundamentals, which is the beautiful thing about the stock market. That's the name of the game: buy low, sell high. That's what the value investor in me understands, right? I can get these great companies at low prices, at low valuations, low PE ratios. You know, PEs haven't been this low since 2019 with certain companies, right? You're getting companies on extreme discount, and people aren't looking to buy into the markets right now. You got some people sitting on the sidelines in cash. Okay, that money, they don't trust the stock market that much right now, that they would rather sit on the sidelines in cash while that cash loses value every single day. Inflation is crazy right now. That dollar is not as going as far as it did in 2020 and 2021, when there was a lot of liquidity in the markets, in the economy, and it was so much free cash flow, so much new money into the economy. That's where we are right now, right? luckily for us with this bear market, and in some cases market crashes in some sectors, the market's already factoring in these economic downturns that we're experiencing, right? And that's why companies are selling so low, because the stock market works a little bit ahead of a lot of different asset classes, whether it's real estate, short-term real estate, or the Airbnbs, or the just actual real estate, whether it's, no matter what it is, the stock market is ahead of all of the other things because of the business aspect of it, right? You'll have, because these are businesses, right? So businesses feel it before most other things during economic downturns, right? Because you start experiencing, because this is just some telltale signs. You'll start seeing some companies do layoffs, because margins are getting unhealthy, right? You got to trim some fat, right? And then you go from layoffs, you go to companies start slowing down hiring, and then you go from that to companies start raising prices to keep up with inflation, because now it's starting to cost more to produce those goods, and people are charging more for services now because everything's in such demand. Labor even goes up, right? And that happens because of all that new liquidity that's into the economy and the markets. We're starting to experience a quantitative tightening right now, where the Federal Reserve understands that it's too much liquidity in the world right now. It's people have all that new money, all that free printed cash flow that that was during the times in COVID. People built up so much in savings. People got so many loans at 0 interest, 1% interest, things like that. It's so much money in the economy. The Federal Reserve job is to increase interest rates and pull some of that liquidity out the market, right? During times of high inflation, when everything costs more, it's meant for you to dip into those savings. This is the job. This is actually their job. Another job is to keep unemployment rates down and make sure people keep jobs. But a part of their job is to make sure we have a healthy economy where it's not too much new money going into it. So what they're doing is they're essentially siphoning out, sucking money out of the economy right now. While inflation is running through the roof and it's high, really high, everything's going up. And what that is it eats up your savings account. It eats up the money that you have, because living costs more. During times of high inflation, living legit costs more. It costs more to live now than it cost in December last year, right? That's a proven fact. People are experiencing that. So a lot of people just have money on the sidelines getting eaten up. They don't even trust the stock market because they don't understand. They just see, hey, my wealth is being deteriorated. I'm putting money in here and it's losing value. Well, what you do is you evaluate great, wonderful companies. You find a discounted buying point that you want to buy into it at, and you buy on the way down. You don't try to time the bottom. You just buy on the way down to the bottom, and then you ride half of that ride back up to the top where you started buying it, and then you hold and you watch. You watch your money, your wealth, and your net worth grow, right? A lot of people went from buying individual stocks to buying indexes, which is cool because you're looking for somewhere to hide out. You're looking for somewhere where you're not losing that much money, right? Where your capital is not depreciating faster than you can turn around in a circle. So a lot of people are going into indexes right now. A lot of people are going into those index funds trying to protect their money, right? A lot of people even going into bonds. People historically don't like bonds. Bonds haven't been good since like the early 2000s. Bonds, savings accounts, CDs, things like that. They haven't been good since like the early 2000s. They haven't yielded any real returns. Back in the day, you could get 10% on your money in a savings account, right? Now you can't do that. It's like 0.05. So bonds don't really yield much, but during times like right now, people are starting to go to bonds. It's all about safety right now, right? It's all about where can I put my money at to where I'm not watching my wealth decrease, right? You gotta hedge against the poverty monster, essentially, is what's going on. So you got people that's going from individual stocks, because these companies are going down way harder than indexes. I told you, Dow Jones down 17%, S&P down 22%, NASDAQ is down 30 plus, right? But you have individual companies that are down 40%. 60%, 70%, 80% right now. You have companies that are down big, and that's why people rotated out when they were still up. They realized those gains and they took them with them to whatever index is getting devastated right now because you're gonna essentially protect that money, right? You're gonna protect it, but the thing is, you're gonna lose those gains that someone like me that's still invested in individual stocks is gonna get over time. Because you gotta understand, if I'm buying a company, my average price point will come to X was 15, and it gave back those gains. Now it's selling at $8, $6, $7. I'm buying more. I'm averaging down. When it goes back up to 15, 20, 25, I'm getting gains on $6 a share, $7 a share, $8 a share. Not that average price point at 15. You have to understand these things. So that's why people get such large returns over a 5-year span, over a 3-year span. Wealth is built during the long term, and you have to endure. Since wealth is built during the long term, and you understand during times of contraction, you have to think expansion. That's how you understand that, hey, this is the time I need to be building out my portfolio. This is the time I need to be doubling down on what I'm doing in order to increase my wealth and my net worth whenever things finally do expand again. And that's what people fail to do and fail to realize, okay? So you got a lot of people that's on the sidelines right now. And I mean, I get it. You don't want that money to get eaten up. You have to be a strong individual to sit here and watch day after day, month after month, week after week, your portfolio just get destroyed, okay? Even when you add more money to it, you usually see your portfolio go up when you add more money. Now it's just like, I know I added $300, but like, why is my portfolio the exact same? Well, that's because you lost $300 over the course of the week, right? But it's okay. When you understand it's a transfer of wealth, when you understand that you're buying great companies that you know are great companies because you did the fundamental analysis, right? You know they have a healthy balance sheet. Even during times of economic uncertainty and economic downtimes and economic constraints, great companies still do good. They still keep more cash and they have liabilities and debts. They still grow their business year over year. They still beat earnings. They still grow revenue. For the value companies and the dividend companies, they still grow earnings, and they'll even increase dividends, right? Even during the economic downturn, it's still possible, right? Because they're doing what we're looking to do. They're even buying great companies during times like this, right? They're buying great companies at a discount. That's smart. They're buying shares back of their company right now, right? And that's smart. Like during times of economic, downturns, this is when great investors, which businesses are great investors, thrive. From the individual investor to the business that's investing in other businesses and things like that. This is the time where you test your mettle and you actually build your net worth, right? And a lot of people are going to miss out on those gains because they're on the sidelines or because I'm going to say head out in indexes, right? Which is unfortunate, but that's the case sometimes. A lot of people are playing on different levels. A lot of people have a lot of wealth that they don't want to see get eaten up. Some people might be retiring. Some people might just have a lot of money, 6 figures, 7 figures, 8 figures that they just don't want to see get destroyed, and that's fine. My goal is to help people understand the value in understanding what a great company is and when to buy or how to buy great companies, right? Understanding what the stock market is and understanding that it's not just a number, okay? Just because you see stocks down X, Y, and Z over the last 2-3 months right now doesn't mean that these aren't great companies, right? We're just in a bear market cycle right now. It's a time of contraction. The economy is contracting. It's looking to. That's what the Federal Reserve wants it to do. It wants it to contract. Let's take some of this liquidity out the market and bring levels back down to a healthy economy. When you understand these things, you understand that you're able to position yourself, I should say. You're able to position yourself in a place to where you can actually come out of this economic downturn. You can come out ahead. Why do you think there were so many new millionaires and billionaires created during COVID? That was a time of contraction, and people expanded. People grew their net worth and their value. They did. It's a proven fact. And the same thing happens right now during these bear market, this cycle that we're in. You can be growing your net worth, right? You can be putting money into great companies that are undervalued right now, but you have to be able to know what a great company is, okay? How do you know what a great company is? Did you read their 10K? Did you read their 10Q? Right? Those annual reports and those quarterly reports. Did you listen to this earning call? Right? Did you look at that balance sheet, that financial statement? Do you understand what that business is doing? Do you know what they're doing in the future? Do you know, are they doing anything to change the world? Do they have a great, strong management team? Do they have a good, strong moat? You have to know these things in order to how high are they being valued right now? They have a high valuation, book to sales ratio, price to earnings ratio. Just simple things that you have to know that you can understand. Like, hey, okay, this is an undervalued company for its sector and for its industry. This is a great company. It's a cash loaded company. It's a revenue machine. It's a revenue growth company. I understand what this company is doing for the next 5 or 10 years. Management has been with them for a long time. They're doing things the right way, right? And when you know you have a great, strong company and you know it's selling 50% below market value, that's when you know it's time, right? You can get a great company at a discount, or you get wonderful companies at wonderful prices. That's when you're supposed to buy. Okay, and that's why you have to be patient when you're building wealth. Wealth is a long-term game, right? A lot of people don't understand that during bear market season, it's time to go shopping, baby. It's raining deals. Okay, now don't get me wrong. Everyone can't stomach that. Everyone doesn't have the emotional fortitude to be able to recognize the deals and go capitalize on them, but at the same time understand that I'm going to be losing money in the short term, but over the long term I'm going to realize some really great gains on this money that I'm losing right now, right? That's why the sentiment of the market is such. Everyone has different perspectives, because you have some people that are like, they're investors, they're trying to protect people's money, hedge fund managers, things like that. They're trying to just keep up with the markets, right? And then you have the people that are looking to invest in a great company, no matter how beat up the price is, or no matter if it hasn't taken off to the price that it should be valued at, because that's what you want to do as a fundamental value investor. You want to buy a company that's undervalued, that should be selling at way higher, but it's actually not, because it's not flashy. It's not a company that the markets have caught up with yet, right? And that's where you'll realize those gains. So, I mean, just keep educating yourself. Keep educating yourself. Keep putting yourself in a position where you can understand, hey, what does this company do? Hey, what does this company represent? Hey, how does this company make their money? Hey, is this company growing these numbers? Are they growing their earnings? Are they growing their revenue? Are they growing their free cash flow, right? Is this company growing year over year? If you can check off those boxes, if you can continue to do your due diligence of understanding what that company is and what they represent, you'll give yourself the best chance to look into the company's future, right? To see how good they're going to do out in the future. If you've seen that they have the reputation, they've been beating earnings for the last 8 to 10 quarters in a row, you got a pretty strong company, right? They're doing something right. And it's levels to this education, and that's why my goal is to get as much information out to as many people as I can, to truly help people understand the way this works, to understand the mindset of an investor, of an intelligent investor. You have to have that emotional fortitude to understand how this game works in order to play, in order to build that wealth over the long term. But in the meantime, between time, you've been rocking with Stock Market Jay, and I'm here to say today, everybody, I want you to sit and just take some time educating yourself. Go watch Yahoo Finance and find out what's going on in the world of business, right? A lot of people spend a lot of time watching the news, the world news, which is, you find out what's going on in the world, but the economy, business, that's what's really impacting your life the most right now, right? And just all time, right? You want to set yourself up for the future. The only way you can do that is if you know how to play the game. Take some time, educate yourselves, gain you some information, gain you some knowledge on investing, and put yourself and your family in the best position to succeed. I'm Stock Market Jay, and I'm here to save the day. Till next time, everybody. Peace.